Well, welcome everyone to the second session of the four-part series, My Money and Me. We appreciate those folks that are joining us again who were here with us a couple weeks ago, and a special welcome to those who are new. My name is Wanda Roberts, and I'll be the host today and doing my best to make sure Adobe Connect cooperates and pulling down some polls. And currently, I'm the co-chair of the Financial Security for All Community of Practice through Extension, and I'm also part of Michigan State University Extension's Financial and Homeownership Education team. So this is a four-part series, but certainly if you're just joining us today, you can learn a lot within just taking one session. And you learn methods that you can follow to identify and work through a variety of money-related issues. We'll also be talking in the next session in 2 weeks about setting up SMART goals and developing a personal spending plan. All of the concepts on investing and asset allocation and diversification you can use, as well as helping folks that if you may work with others around financial education and investing. And this My Money and Me series has been developed in collaboration with Michigan State University Extension and the State of Michigan's Investor Education Your Community program. So, part 2, Getting to Know You. We'll examine information about debt and spending-related patterns that are behavioral or like habits. And we'll also look at a process for modifying any negative patterns. We'll also talk about how we analyze assets, liabilities, and net worth statements, as well as cash flow statements for any problems that are potential or actually may be happening. And we'll be doing that as we apply personal financial ratios. And of course, as long as you have your email in the chat pod, at the end of the session today, I will email you the handout that will give you how to calculate those financial ratios. Most of you have kind of already got it. You've put your name, email, city, and state in the chat pod. And if you would like AFCPE continuing education units, let me know that also, and I will send you a certificate. As always, I will do my best to monitor the chat pod and have Mark answer questions that as we go along and as it's appropriate to interject into the presentation. So, Mark Robinson again is our presenter today, and he has 27 years of professional experience in the financial services industry. He's a Certified Investment Management Analyst, and is an accredited investment fiduciary analyst, a mouthful, lots of letters behind his name. And he's provided investment-related advice and services to individuals in mostly all private trusts and small nonprofit entities. Mark has been the one that's developed the State of Michigan's Department of Licensing and Regulatory Affairs. It's our regulatory body here. The Investor Education Your Community program that he has created and is the lead presenter on. So, without further ado, Mark Robinson.
And thank you all for coming to part 2 of the My Money and Me series. And I see that we are literally from Alaska down to Alabama and from Delaware over to California. In part 1, Know the Flow, there's a lot of definitions, frankly, on assets, liabilities, net worth, cash flow, understanding what asset classes are, stocks, bonds, and cash, the interrelationship between them, and the distinct risk and return attributes of stocks, bonds, and cash. Today is Money, Getting to Know You, which will be an analysis of Bill and Penny's balance sheet to see what is going on with their relationship with money. So we'll do a little detective work of their balance sheet and see where they're pushing off those 100 pennies we have in a dollar. And then we'll look at asset allocation and diversification. And of course, we'll have some polls sprinkled in throughout. All right, let's take a look at Bill and Penny. Here they are, the good-looking couple, and as we learned in part 1, Know the Flow, there are 4 basic things outside of gifting your money away that you can do with your money. You can spend it, you can pay down debt, you can save it, and you can invest it. Well, so too with Bill and Penny. So if we look at the cash flow statement on income, we could see that their gross income per pay period, they're both working, $11,000 monthly. And their net income, which we've arrived at with a little calculation here, and for this purpose, is $6,420. So there's their income. And let's look at ratios. First, the liquidity ratio. How much money do we have to where we could get our hands on it, either right now or within 24 hours? And so when we look at their income and what they're spending, which is around $6,400 a month, and we look at their assets, liabilities, and net worth statement, and we see $5,000 in cash accounts, and we see $10,000 in a brokerage account money market, we see that they have a liquidity ratio of 2.3 months. In other words, that $15,000, if they're burning $6,400 a month, would last 2.3 years. Now, we want a liquidity ratio that is 3 months up to as much as 6 months. And what would determine that would be the stability of your income. As we learned last week, do you have stable, ongoing income, or is it less reliable and variable? It also depends on what your profession is. For example, if you are a court justice, you might have a very stable income. If you are a contractor in a cyclical industry, though you're very good at what you do, as that industry goes, often so does your income. So those would be things that would modify what a good liquidity ratio would be for your emergencies or to pay for your essentials if indeed you become unemployed. All right, let's look at the monthly debt to monthly income ratio. What goes into that? Well, your house payment, owner's insurance, property taxes, fixed recurring expenses, for example, auto loans, and of course your credit cards. So when we look at that ratio and we divide that by the gross income per pay period, it's at 29%. And where we'd like to have that is somewhere in the 30 to 36% range. So on the first two ratios, I don't see any problems yet for Bill and Penny. Let's look at their housing cost ratio. So that would include the house payment, in other words, the mortgage payment, any insurance, and the property taxes. And we're going to take that and divide that by, again, their gross income, $11,000 per month. We'd like to see that around 36% or less than 28% or so. So here we go again with the housing ratio with Bill and Penny, no problems yet. Loan to value. Here's where Bill and Penny are. Their residence, well, they owe $200,000 on the mortgage, and it's valued at $225,000. So the loan relative to the value, market value of the home is 89%. Now, that's not too bad, and let's cut Bill and Penny a break. And let's say that maybe when they bought that home, it was $250,000 or $275,000, and where they bought it, well, that market has yet to recover. So I'm going to give them a pass on that loan-to-value ratio. Let's look at the consumer debt ratio. Now, this is based on what you are paying out for your cars, your boats, other recreational vehicles that you have a loan against, and your credit cards, and we divide that by the net monthly income. So they're bang on with that. We'd like to see the consumer debt ratio at 20% or below. Total debt to net worth. Bill and Penny's liabilities are $257,000. But their total assets, all in, including what they have in brokerage accounts, savings accounts, and the value of their home, is at $428,000. Would like to see the total debt to net worth ratio at 1 or below, and here's where we are. So they have a positive net worth. Still no problems with Bill and Penny. Total debt to income ratio. So we'll take a look at the entire debt that Bill and Penny have divided by their income, And we see that that ratio is 1.94. Now you're thinking, Mark, that doesn't mean anything to me. Well, it's not going to, because it is an age-based ratio. So if we take a look at where Bill and Penny are on this, in their 40s, what they should have is a ratio, let's split the difference, of 1.5%. So of their total liabilities, those should be lower than what they are. Now just get the intuition on this. As we are younger, in our 20s and 30s, we are in acquisition mode. We are buying things, cars, homes, and other fineries to put into the homes. And we're having kids, raising kids, and that drives up the expenses. And then once we have all of our things, let's say, bought, we need to start concentrating on working down our debt relative to our income so that, as this goes, when we get close to retirement age, we are not carrying a lot of debt. Now, these ratios, they're just general guidelines, so I don't want you to get all freaked out about them. You don't need to. Ratios that are higher than these general guidelines may not necessarily prove to be problematic, and ratios at the lower end, I don't mean it's an all clear for you either. These are just general guidelines. Savings rate to income. Perhaps we have a problem here with Bill and Penny. They're only saving 3%. Now here's two people that are knocking down $11,000 a month between them, yet they're only putting away $330 a month. So their savings rate to income ratio is only 3%. Now, the recommendation is for 10% to 20%. And the thinking is that you can't save enough. Now, we don't want you living off of soda crackers and water, but it's important to take as many pennies out of those 100 that comprise a dollar and push as many as you can off into some type of savings plan, either through your employer or in IRAs or just into your own savings account or brokerage accounts. Savings to income ratio. Well, here's the savings. And if we add that up, it's what, $105,000, and they're making $132,000. So this, again, is an age-based ratio. And let's see if we have some problems here with Bill and Penny again. We certainly did with their debt to income, and how we see a problem here with their savings. Bill and Penny, at roughly 43, 44 years old, should have $231,000 saved. They're nowhere near that. And the thinking on this is we want to work down our debt to income ratio, to where we get as close to being free and clear going into retirement, because we don't want the drag of all of that debt eating into what might be fixed income. We need to save enough also so that we can draw from that. And the thinking is that you need to have anywhere between 10 times your income to 12 times your income, your peak income, to sustain you during your retirement years, which could be over a multiple decade period. Now, you can look at this and say, I'm nowhere close to that. And again, it's just a general guideline for you to grasp the intuition of this. Reduce debt as you age and save so that we have something to draw from when your earned income is either cut out completely or dramatically reduced. Now here's the math on this. They're making $132,000 a year, and at a 12 times that, they would need a little over $1.5 million to sustain a 4% withdrawal rate, and we're just using that as an example. I'm not so sure there is such a thing as a safe withdrawal rate. We've estimated their Social Security so that with the combination of those two, we will be able to replace 80% of their earned income. So there's the math on it. Now this is really more about relationships, and this might be a rather difficult chart for you to grasp, and I wouldn't be surprised I made it. But what we show here is the income, starting back in your 20s, and we're going to assume a 3% annual increase, straight line increase in the income from your 20s out to when you retire at 67. Now we can see with the total spending to where that really kind of matches our earned income in our 20s and 30s and arguably into our early 40s. We're buying things. And then it should begin to level off as we get into our 40s and 50s and 60s. At the same time, the red line, which is our debt service, we're buying things and financing them, is peaking in our 30s and early 40s and then begins to drop off. Now, what we do is with the excess, because we're spending less and our debt service is less, so it goes, it should be going into your retirement assets and growing for you at a rate at or above the rate of inflation, so that when we get to retirement, the benefits that you have in your assets, when we assign a withdrawal rate to them plus other benefits, will come close to what your income was, or at least meet your spending going into retirement. Now, that doesn't mean we have to save up a lot of money. Not necessarily, because if you never were a big spender and you were a saver and you don't carry a lot of debt, then you don't need to have such a large pool of money that you would have to withdraw some percentage from, plus your Social Security to meet your spending. So again, general relationships here, and I just want to stress one thing. It is always in your better interest to reduce your debt and save as much as you are able to, so that the combination between low debt and sufficient resources that you can draw from will take care of your spending going into retirement. So let's look at Bill and Penny's ratio. Liquidity ratio, yeah, not bad. Monthly debt to monthly income ratio, within normal limits. Housing costs, within normal limits. Loan to value, consumer debt ratio, total debt to net worth ratio, all good. What's the problem with Bill and Penny? Well, here it is. The total debt to income. They have $257,000. Had they been working on reducing debt, arguably it should be closer to $200,000. Their savings rate to income ratio, only 3 times, or 3%. They should be saving more like $1,100 per month at 10%. And the savings to income ratio, well, they have $105,000 saved, and looking at the glide path on that, it should be closer to a little bit over $200,000. So we see where we have some problems with Bill and Penny. Here's it is. Look at their payments. 25% of the net income goes out for groceries, coffee shops, lunch, eating out of their $6,400. So we can conclude that Bill and Penny are party animals. They are just spending up a storm here and not saving and planning for retirement. Not unlike a lot of us, because you know what? It doesn't hurt while you're doing it. But this behavior in isolation, all we're doing is having fun, and it doesn't seem like it has consequences. However, if we take that same behavior and put that over a 20 or 30 or 40-year period, and then you wonder why you don't have sufficient assets to sustain you during your retirement, it starts this, day by day, party hat by party hat. All right, so let's go back and take a look at what Bill and Penny might be able to do. They've got that recreational vehicle. It's a boat, and the value on it is $15,000, and they owe $5,000. Now, presuming that those numbers are good, we could take a look at perhaps selling the boat. We've got a boat loan on it of $90 a month, and we see what's going on with their credit cards. They have $17,000 in credit cards, $425 in monthly debt service on that, and that's just making the minimum payment. So some potential solutions here would be obviously to reduce discretionary spending. We could sell that boat, put that onto the $17,000 balance in credit cards, which would result in a $345 reduction in the monthly debt, and then apply that to the retirement savings. So we could increase the savings rate to income to a nice healthy 15%. So again, this is a behavioral issue on looking at what comes in, and then with that net income into the house, understanding that there are only 100 pennies to the dollar, where do we choose to push off those pennies, and where do we choose to redirect them from perhaps spending or behavior patterns in spending that are working against us when measured over the long term? All right, let's move over to asset allocation and diversification. "'Tis the part of a wise man to keep himself today for tomorrow and not venture all his eggs into one basket," and as Wanda J always says, "and make sure that all your baskets aren't filled just with eggs." That completes the whole idea of asset allocation and diversification, which has two purposes, and they're inextricably linked: manage risk or volatility, and increase the overall return potential. Let's look at some definitions for risk. Risk from a Graham and Dodd standpoint is the possibility of taking a loss. That means losing money. In the financial services industry, we often use risk and volatility interchangeably. And volatility is just the uncertainty about the size or change or fluctuation in a security's value, which doesn't necessarily mean that it's putting you at risk with the possibility of taking a loss. And the big word that we use for volatility is standard deviation, which is just a measure of the magnitude of the dispersions of returns on a securities. Higher standard deviations have higher risks. Lower standard deviation securities, arguably lower risk. So here's what this might look like. I don't even know what color that is, let's call it brown-green, might be a more volatile securities, let's say a small cap stock, and the dispersion of its returns around its average. And the other might be a 2 or 3 year corporate bond, much tighter range in the variance around its average. Now, here's where volatility means risk. I have a long-term investment, like the stock market, and I need money in 2 years, but I'm going to try to help myself because more often than not, the markets are up. So I absolutely necessarily knew I had money earmarked. I needed $10,000 and I needed it in 2 years, but I know all the people on Wall Street that know how to only pick the really good stocks and how to avoid all of the bad stocks. And I thought, I'm going to put my money in the stock market because $12,000 is a lot better than $10,000 2 years from now. Well, the volatility didn't work in my favor over that very short period. So we can see, like cholesterol, we have two types of volatility. We have good volatility and bad volatility. Because I tried to match up a long-term investment to a short-term time frame, and I needed to sell, this is where volatility actually means risk. Now here's where volatility only means volatility, and I actually take advantage of the more upside volatility that when measured over long periods of in the markets we experience. Then downside is where I put $10,000 in an investment in the market, and I have a long-term time frame, and 20 years from now, I sell it at a profit. There's where volatility only means volatility, and the volatility actually works as your friend. When we place monies into the markets, we have three types of risk. We have market risk, which is systemic risk or market risk, and that's a context thing. When you're in the market, you have the risks of the market. And then within the broad market, we have industries and sectors. In fact, as measured by the Standard & Poor's 500, we have 10 sectors within the economy. So we have 10 sectors that all have their own unique risk attributes to them. And then within each one of those sectors or industries, we have companies. So we have the risks of the companies also. Now, 70% of the risk of you being in the markets are industry and sector risk and company-specific risk. So part of asset allocation and diversification is to try to remove as much industry sector risk and company-specific risk so that we are left primarily with just the risk of the market. Asset allocation is the process of divvying up a portion of your money into different kinds of assets, such as stocks, bonds, cash, hard assets, and real estate. Diversification is then the risk management technique that mixes up a wide variety of investments within each asset class. All right, we have a question coming up, and let's take a poll. I would like 60% of my portfolio in stocks and 40% in bonds? Is this an example of asset allocation or of diversification? Now, you either all did a quick Google check, or you know your stuff. And let's close the polling on this. But indeed, you're right. It is asset allocation, because asset allocation is dividing up your monies among the broad asset classes: stocks, bonds, cash, real estate, and hard assets. All right, here's the process. Again, asset allocation is not about allocating your assets. It's about allocating your monies among some or all of the asset classes. And in this case, I put 50% into stocks. Now, typically when we talk about stocks, we will use as a surrogate for stocks the S&P 500. So I have all of my monies in the S&P 500 in my stock allocation. The diversification process is me looking at that and saying, well, I want to have some large cap, but I'd also like to mix that up with some mid cap and some small cap and some foreign stock also. So I've gone from asset allocation to diversification. And then the next step in this is the security selection. So in this example, for mid caps, I might have an actively managed mutual fund with a mutual fund company with a good track record. In small cap, I may have another actively managed mutual fund and just buy an index. With foreign, if I'm going to be in foreign, in this example, I want to be in emerging markets. I think there's a better bang for the dollar there. And with large cap, though it's very difficult to beat the stock market, particularly in the large cap space, I'm just going to buy an index. I think energy is going to continue to be a good sector, so I'm going to buy an energy sector exchange-traded fund that focuses only on that sector. And I think I'm pretty good at picking stocks. So I'm going to buy a basket of individual stocks. So we've gone from asset allocation to diversification to security selection. All right, our next poll question. I think, please look away from your screens.
That doesn't make any sense.
Okay. I would like to have 70% of my stocks in large cap, 20% in small, and 10%. Is that diversification or asset allocation? All right, for the most part, you've got that right. And that is something that you need to be able to separate. And a lot of people confuse or think that asset allocation and diversification are the same thing. They aren't. Diversification is what you do within the asset classes. So we have that pretty much you've answered quite well on the last two polls. Oh, okay. So we have diversification reduces company-specific risk, sector risk, market risk, or all. Or excuse me, A and B. Wanda, I think we're making the quiz questions too easy. You're right, it is A and B, but that's important as just good reinforcement. When you place monies into the markets and you diversify, what we're trying to do is get away from more specific types of risk or sector risk. Now, in diversification, if what you are trying to do is to add beta or add more return, then this is where you start focusing more and concentrating on companies very specifically or into specific sectors. But for the most part, when we try to diversify and get as diffuse as we can, what we're trying to do is get away and diversify away and minimize the company's specific risk and the sector risk. Good answers. Asset allocation and diversification prevents you from having all your assets in the worst investment. The trade-off is not having all your assets in the best. The potential risk reduction benefits of diversification and the potential for higher and smoother rates of return can be improved not by adding more stuff, but by adding investments that when we combine them together, their prices move inversely or at different times in relationship to each other. And there's the real art in diversification, is getting securities that move differently in relationship to each other. Now, the academic wonks have come up with securities that are perfectly matched, have a positive correlation of +1. Perfectly negative correlations would be a -1. And when we can't explain the movement of one relative to another, there's a 0 correlation. And of course, we have all of the degrees in between on this. So in this example, we have 2 securities that are highly correlated. They're all moving up in price when measured over the long term, but we have one that is lower correlated, that moves differently in relationship to the other 2. Now, just looking at that, you can see, almost from an engineering standpoint, the counterweighting that's going on. They're all moving up, just at different times in relationship to others, which has a smoothing effect on the portfolio's return, which is what we're looking for. And it's very difficult to find low or negative correlated securities anymore because of the high correlation that we have almost globally among the securities. And it's almost like trying to find Waldo. But if you are a financial services provider, you are looking for Waldo. And if you are not a financial services provider, you ought to be or be seeking out a financial services provider that knows the importance of putting low correlated assets, or excuse me, investments into your portfolio. All right, poll question. I've noticed that my stock mutual funds returns tend to fluctuate differently in relationship to my bond mutual fund. Is this an example of 2 highly correlated or 2 lower correlated funds? Okay, again, overwhelmingly, you answered correctly. 2 lower correlated. Great. So we know the answer is 2 lower correlated, the stock fund and the bond fund. All right. Which combination? Yep. No, we didn't show the answer yet. Which combination brings more difference in holdings? You're thinking about it, and that's good. And we're looking for difference. All right, let's go to the answer on this. The answer is B. You're going to ask why. And so this requires some qualification in here. Let's look at answer A. I have mid-cap value stocks and small-cap blend. Those are 2 very highly correlated. I can explain about 98% of what small-cap blend is doing by mid-cap value. Typically, not the spiffiest balance sheets either in mid-cap value and in small-cap blend as a general rule, and I'm combining them with lower quality corporate bonds, which often act very much like small cap blend stocks. So the debt in lower quality corporate bonds typically don't dance in a highly correlated way to interest rates. They do to GDP. So when I look at them together, they could almost be kissing cousins. Let's go down to C. Large cap growth, large cap value. Put those together. I've got large cap blend. I've got mid cap growth, mid cap value, which in effect is mid cap blend and small cap. So really all I have there is the total stock market, which really doesn't bring a lot of difference except by capitalization. And we can explain, these are so highly correlated, about 94 to 98% with small cap and mid cap correlation to large cap. So I'm not really getting difference. It's more stuff, but not different. Now, why B is different is that I have high quality large cap growth stocks combined with emerging market stocks combined with government bonds. And so out of these three here, with some yeah buts, and that's fine, would be a better example of more difference in holdings than the other two examples. Now, don't get too hung up on the line here and where the blocks are. Just grasp that when we look at this from a time standpoint and a risk standpoint, we have the lowest returns with cash, and we have the higher returns for foreign stocks. And as we work through time, seeking higher returns from large cap and small cap in foreign stocks and arguably long-term bonds, if we have the time, the volatility that they have and the return potential could work in your favor, but we want to indeed look at how much time we have and their appropriateness based on time. Okay, part of the problem is we need to go back and do a poll on this. And part of the problem is that Wanda is doing crunches upside down in her inversion boots and trying to run the polls here. Okay, so which portfolio is riskier? Now, this is interesting because overwhelmingly, you're saying that the 60% stocks and 40% bonds is riskier. So let's take a look at that. The answer is actually the 40% stocks and 60% bonds. Let's look at this, and this will draw from what you've learned today as well as from last week. Why is the 60% stocks, 40% bonds less risky? As we learned last week, large cap stocks have a lower volatility or standard deviation to them and have better balance sheets for the most part, in the most general terms, than do small cap stocks and foreign stocks. When we look at higher quality corporate bonds and shorter term government bonds, higher quality corporate bonds are less exposed to credit risk, and the shorter-term government bonds certainly have no credit risk and have reduced interest rate risk because of the short-term nature of them. Now, the riskier portfolio has 30% in large cap stocks, same percentages in small cap stocks and in foreign stocks, but look over at the bonds, and here's where the clue is as to why this is riskier, both from a potential standard deviation, just the wiggle in the return, and from a credit quality or from a interest rate risk. I have lower quality corporate bonds, and they are subjected to credit risk, and I have long-term government bonds, whereas if we have a move up in inflation in here and rates move up with it, those long-term bonds carry tremendous interest rate risk to them. So actually, the 40% stocks and 60% bonds, really the risk brought in here by the bonds is how we want to look at this. All right, next week we're going to get smart about money. Decisions about our money, the kooky relationship that we have with money, some of the behavioral aspects that we have in there. We'll set SMART goals, spending plans, and a sequence for making investment decisions. Wanda, do you want to finish up here?
If anybody has any questions, they're welcome to type it into the chat pod. We obviously had lots of time left today. I'll give you a minute to think about it. Kind of a lot of information that was covered. I see there's someone typing, so we're giving them another minute. So Karen has a question about getting the PowerPoint. Is there a way that we could put that into a PDF with a few of those slides, Mark?
What we can do is post a transcript of this. So most of this is available in a transcript form for you. So we'll find a way to get that right. Yeah, thank you, Diane. We do throw an awful lot at you, and in fact, I could have had more slides in here, but I took some of them out, and you'll be seeing them next week. What we don't want to do is bore you to extinction, so often we opt to put as much information as we possibly can in here. And so if we take the risk of doing that, we need to be able to have a way to where you can go back and at your own pace be able to digest this a bit better.
Well, thank you everyone for attending today. Though it was a short session, it was packed with lots of information. The recording for this session will be posted on the Extension Learn system, as is the first part of the series. Mark would like to answer Suzanne's question. Yes. Talking about, I mean, obviously when we work with consumers and there's challenges to their income and expenses and basically their spending plan is out of whack, what if the client wants to keep the boat? What would we suggest, or what would you as a counselor suggest? And basically for me, I would go back to, and actually we'll talk about it in the next session, part 3, about setting goals, because in reality, as we know, those individual consumers have to make those choices. And if they're not willing to give up something, I mean, some people are willing to lose their home and keep other things, but it really has to depend on what their goals are now, what their goals are in the future. So spending some time working through the SMART goal sheet would be a start. The snowball debt reduction plan or option, I'm trying to think, that's not something that we really talk about in the My Money and Me series. I know I've talked about it before in some other money management sessions, but I'm assuming, folks on this webinar are familiar with if you're, say, paying $200 a month on a credit card, you pay that off, you keep paying the $200 on the next debt. So basically snowballing your debt reduction. But yeah, Suzanne, it's not something that we cover here. Oh, hold on a sec, Mark's got some 2 cents worth.
Hi, the snowball effect is very popular because often we get into debt emotionally, and a way to get out of debt is to address it emotionally. And let's say, for example, you have 5 credit cards and one has a lower balance on it. It can feel good, therefore it's an emotion, to take care of one and get that paid off as quickly as possible. Then we go from 5 envelopes we're opening and putting our palm against our forehead every month on, and now we're down to 4. And then you work on the next one with the lowest balance. Now, that's addressing it perhaps on how you got into trouble, was emotional, and then getting out of it that way. Now, Einstein said that often the type of thinking or the way of thinking that got you into trouble is not the way of thinking that will lead you out of that problem. So from a pure mathematical standpoint, what you want to do is start putting more monies onto the credit card with the higher interest rate attached to it. And then put minimum payments on the others. And then when you have that one paid off, start on the one with the next highest interest rate attached to it also. From a dollar and cent standpoint, that one makes the more sense. The other one, snowball, addresses it emotionally. And I really don't care. As long as you are focused and your intention is to reduce the debt, I say go for it. I don't care what your approach is.
So if there are no more questions today, we will end the session. We appreciate everyone attending, and we hope you'll join us on October 9th for getting smart about goal setting and spending. Have a wonderful rest of your day.